Hey guys, what's up and welcome back to this YouTube channel. It's your guy Igor here.
And it's your girl Neetu here in the middle of Chinook where it's blowing wind.
Guys, it is basically an iceberg, a tundra. And guys, what Nito told me yesterday, she's like, Igor, you know what? If Canada joins United States, we are moving to Florida. I was like,
No more jackets!
no more jackets. Honestly, guys, with the price of real estate in Canada, like in Calgary, I'm not talking about Toronto or Vancouver. Give me a hand, they're gonna fall. You can buy a mansion, in Texas and other places. Honestly, guys, this entire Ponzi scheme and real estate, people told me not to say Ponzi scheme because they said they work for Chinese government and they don't want you to know. Somebody actually commented on our last video, I'm not joking about this comment, and I even like that comment because maybe it is true. Maybe it is Chinese government getting into Canadian politics. But today we want to talk about Canadian rich people who don't pay taxes and how they avoid paying taxes through mortgages, through refinance and cash damming and other things. So we'll be talking about on this topic a little bit. Now, quick disclosure, guys, this is not a tax advice or a financial advice or a legal advice. So don't sue us for whatever we say. Do your own research and consult your CPA. With that being said, here's a mortgage professional with DLC Realtors Mortgage and a realtor with EXP Realty. All right, Nitu. So let's talk about refinance. How does it work? That refinance. By the way, in the last 2 years, Nitu, what were you going to tell about the last 2 years? You forgot. If you had a mortgage in the last 2 years, it's about time to refinance. So refinance is coming, and this information is going to be available.
But that is only valid if your property value has gone up. Now, if you're in Ontario, too bad for you. Property values are going down. I recently saw this ad where they have listed at 1.25 and they crossed it down then to 1.1 and they crossed it down for $800,000. It was finally sold. So if that's you, I'm sorry to say you may have to wait a little bit longer to see when exactly the property value are going up. But refinance is essentially done when you at least have 20% of it paid off or increased in equity value or even more. So how they do it is, if your property value is, let's say, $1 million, they take 80% of that deducted by your actual mortgage balance. It needs to be less. Whatever remains is what you take out as home equity line of credit, or you can take out as cash, or you can even pay it off for other personal lines of credit, or loans.
Guys, look at this iceberg floating next way, just so you know what's going on there. Guys, it's iceberg happening. So basically, guys, what you need to explain to you in a common language, what I'll tell you, like one of my clients, when I just started real estate like almost 4 years ago now, he told me, he's like, Igor, you know what? Your real estate is essentially could be your credit card with insanely low, close to zero interest rates compared to credit cards or lines of credits. And my Nito was not a mortgage broker at that time, and I heard that, and I was like, I don't know what this guy is talking about. And then I realized that he was right. So essentially, if you have a property paid off, you could pull out equity from that property through refinance. And there is also such thing as home line of equity, HELOC as well.
Home equity line of credit.
Home equity line of credit. What's the difference? Like, what's the better interest rate?
So obviously, home equity line of credit is associated with your home, meaning that's as a collateral to your home. So if you don't pay that, they will essentially take away your home, and because that is there as a collateral, they will charge you lesser interest as compared to any other lines of credit where you don't have any collateral. So basically, secured line of credit and unsecured line of credit where you pay a higher interest.
Okay, makes sense. So guys, but quick disclosure, what Nito hasn't said, banks don't really want your homes in Canada because to sell them as a real estate professional, I can tell you, it's a headache. First of all, you need to go through court, you need to go through legal proceedings, you need to get it appraised, then you need to sell it, and usually taking away your home is not a good option for the bank. The best option for the bank is that you keep on making payments on time, and you keep on taking home line of equity and you never pay off your home and you pay forever. So that's the ideal world for banks. In reality, the truth about the banks, I gotta tell you, they really don't want your home because they can use that alliance and mortgages and stuff like that to take debt from other places and use that money almost as cash. Your debt is basically cash for the bank. But anyways, that's a separate video for a separate topic. But there is so need to this home line of equity. Somebody told me I can literally have it in the form of like a Visa card. Like, does it have to be like that?
Well, if you want to, you can. But you have to make sure that, it's essentially two payments. You're paying for an already existing mortgage, and on top of that, you're paying for this. Of whatever you're going to be using as a Visa card is whatever essential you have paid it off or increased in appreciation.
Yeah.
It would be in your best interest not to use as much, but if you
Yeah.
do something, legally, cleverly, like what our accountant advised.
About yeah,
About,
cash. I mean, we'll talk about not paying taxes in a moment, guys. But you have to
yes.
understand there is a difference from what I know. So what's the difference between refinance and the home line of equity in terms of a loan? Like, what's the benefit of each one?
So refinancing is basically whenever you are taking, let's say, more money. Let's say your current mortgage balance is 350, and you want to take, let's say, 50,000 more, stretching your mortgage balance to 400,000. That's refinancing. If you are not at the end of your mortgage term and you want to break your mortgage and stretch your amortization back to, let's say, 30 years, that's refinancing. So whenever you're going out of the way to do something different than what your contract term dictates, essentially there you pay a penalty and there you break a mortgage.
Okay. But
Yeah.
home line of equity is essentially a separate loan that goes on your title, like almost like a second mortgage, right?
It can be first position along with your mortgage, as well as a second position, depends on which bank, which lender.
Yeah.
But it's essentially like two payments. You
Yeah.
pay your original mortgage, payment one, and payment two for home equity line of credit of whatever you take out the balance. But the good thing is that there is no penalties. You can pay it off anytime
Yeah.
sooner, and you only pay for whatever you take out.
And also, you don't have to take out everything. So you could have it, but you don't have to really use it, right?
Correct.
Okay, guys, now let's talk about not paying taxes, because that's my favorite topic, guys. And it's not like I'm not paying taxes or something like that. I'm unfortunately paying a lot of taxes, and too many taxes, because we are in Canada and we have lots of free stuff given away to people from other countries coming in and taking all the subsidies and stuff like that. And I want to be like an old stock Canadian who is complaining about people coming and abusing our tax system. But anyways, that's a topic for a separate video. I'll be complaining about paying too many taxes. Here's what rich guys do in terms of not paying taxes. So it's called cash damming, guys. And essentially it is what, like, for example, you see what Nitu is saying, that, for example, you're a wealthy person, right? You're taking out a home line of equity. So you have equity, you are wealthy, right? But if you sell that house, right, you might have to pay cash equity gain tax and other things. So the trick is you don't sell it, but you can take a loan. But you take out cash out of your equity, but at the same time, it's not really taxable because it's coming out in the form of a loan, right? And there is also another thing which is called cash damming. And once again, I'm not an accountant, guys, and don't treat it as tax advice, but if you use that loan for business purposes, that interest out of your own equity could be a tax deductible. So not only you're taking out money, okay, let's go that way, you two, because it's getting too cold this way. So not only you're taking out money from your loan and you are using it for business purposes tax-free because it's a loan, you don't pay taxes on the loan, you're also using that loan for business purposes, and because of that, you're paying interest, which could be otherwise classified almost like as a tax, right? If you take out cash, you have to pay a tax. But if you take a loan, you have to pay interest. And some of you can say, well, interest is literally a tax, right? So essentially what happens is that you took that loan, right? And for business purposes. Now, according to the basically tax regulations in Canada, that interest that you're paying for business purposes could be actually a tax deductible from your business incomes as well. talk to your CPA. But that's essentially how people in wealthy people in Canada use cash damming, and it's complete. I'm not telling you how to cheat the system. I'm telling you what people are doing, and now you know. So you can actually use that money from your personal equity, where you get the interest from, to generate business income like an investment property. Now that investment property generates rental income, but you have to pay an interest on your personal loan, talk to your accountant again, to generate that business income. And that expense, which is your basically principal interest payments, let's say interest payments on that loan, is your expense for your business income, which can be tax deducted from your revenues that are coming from investment property. That's a short explanation on how cash damming works, guys. But I didn't teach you anything wrong in this video. I'm just telling you definitions of things. And also keep in mind, guys, I want to tell you why I'm saying to go to a tax professional is because you have to know your entire picture of talk to your CPA, not a bookkeeper. CPA, there is a difference. Bookkeepers know nothing in Canada. Talk to a professional who is licensed CPA, chartered accountant, and they have to look at your entire picture, your family income, what your wife is making, what your dog is making. I'm just joking, but we have to know the entire thing, sources of income in your specific situation, to know whether it applies to you, or if it does apply, what are the restrictions, regulations, which province you're in, and everything, whatever you need to know. So that's why you need an accountant. So don't just go by, Igor's video on YouTube and then say, well, Igor told me and stuff like that. And more importantly, don't sue me, because guys, it's only for educational purposes, this video. So that's essentially what people are doing, and it's surprising to me, guys, that many people in Canada don't even realize that you could, essentially pull out equity out of the property that went up and use it for investment purposes.
Right now, what is even more beneficial, according to what the government has announced, is the 90% loan to value. Initially, it was only 80% loan to value. Basically, you can take out 80%, for refinancing. But right now, if you are using refinancing option to build either a laneway home, that's basically a garage home, a suite on top of your garage, or you're building a secondary suite basement, you can take up to 90% of your property value deducted by whatever your mortgage balance is remaining. That's how much money you have to take out. But there is a clause, and this clause is that you have to use that money to build these suites.
And there is a trick too. You go ahead, I'll add something.
You have to build the secondary suites. Now, when this came out initially, and it was, I think, in the province of British Columbia, when they said, if you're going to be using it, you have to use it in such a way where your rent is 10% below the market rent that is going and as of right now. So just be careful.
Read all the clauses.
Read all the clauses, and this can be applied directly with either the federal government or the provincial government. Do your own research. It's not done by mortgage brokers, so don't call me for this. But yes, I can do refinancing up to 90% if you want to take that as a mortgage refinancing.
Guys, there is another clause that Nito hasn't mentioned, which I like reading those details in between of the lines, where they're saying that 90% loan to value of your future appraised value of your property. That which basically means, as guys, that check it on the website, because that's what I remember. I like finding small things in contracts, I tell you. So essentially means that your property, you might not have 90% loan to value on your property, but because after you develop that secondary suite, your property value goes up, and a future value could create a 90% loan to value, they would give you that loan. That's one clause that I read. Okay. Nito, did you see it?
No.
But I read it and I found it, guys, and that deserves a like on this video. And subscribe to this video as well, guys, because that's an actually interesting thing that when I saw it, I was like, had a light bulb out of my butt flaring out. I was like, whoa, this is awesome. Did people actually realize that? Did they realize that your, like after you build a basement suite, your property value might go up by $50,000, and then with that $50,000, let's say extra value, now all of a sudden you would have 90% loan to value. So they do it at a calculation, and appraisers can do that. Appraisers can say that it's going to be this much
But
after they're done.
if it was me in your shoes and you wanted to do something, let's say secondary basement suite, I would, you know, when you're going to get an approval for a mortgage, I would just go for purchase plus improvement loans than going for any of this.
Yeah.
Because, you know, that is essentially going to give you the money, and that money can be combined with your mortgage at the lowest possible interest rate. So I probably that could be like a third possible option for you to
Yeah.
consider, but I feel that would be the best option, because there would be no clauses attached,
No,
you know, to put your
Yeah.
rental income below the market,
Exactly.
if at all you want to take use of that.
I think that government option, guys, exists not for people who are buying a home, but for people who are already in a mortgage, who are already owning something, and they're like, I want to build a basement suite, but I don't have the money for it. I think that's a. But what Nito is saying, if you are buying a property, I think your option is better actually. All right, guys, I'll leave Nito's contacts in the description of this video. We're going to be stopping this video because we are not going to upload this video. We're going to freeze here with the wind, guys. It's Calgary. It's an amazing place, and it's Nito.
It's a peace bridge.
Yeah.
Behind us.
So we are waiting for peace. There is already peace in happening in Palestine. Now we are waiting for peace in Ukraine, and peace for
All over the world.
all over the world, guys. Thank you so much for watching.
Peace out.
Bye bye.